We realise that a lot of customers, they're not familiar with lawyers, and sometimes they're familiar with lawyers and it's been a bad experience.
Yeah.
It can often end in tears. Clients and their lawyers aren't always aligned, unfortunately. We want to be very aligned with our clients, so what we offer is it's a no-win, no-fee.
Cathro and Partners presents The Cut, a podcast about all things insolvency.
Hello everyone, this is the final episode of the 2023 season for The Cut. We've got two guests today, a little bit different. We normally have one. Welcome Luke Whiffen from Hilton Bradley Lawyers. How are you?
Yeah, good, Simon.
And Terry Watson from Watson Trade Credit. So we've got a little bit of a different topic today. We're going to be talking about two topics, one on sort of trade credit insurance, and we'll start with Terry, and then we're going to swing into some discussion that Luke's going to talk about is the winding up process for a company and for creditors that want to take action against a company that owes them money. So how are you, Terry?
Yeah, fantastic.
So, Terry, you've been in insurance, trade credit insurance for some time. Give us a bit of background to sort of where you came from and what Watson Trade Credit's all about.
Yeah, sure. Look, I started 14 years ago in trade credit insurance. Started my own business just almost 10 years ago now. It's been a bit of a whirlwind, you know. I started in Parramatta, opened an office just down the road here in Surrey Hills after I sort of signed my first few clients. And then we sort of started spreading out. We've got clients all over the country now, every state except for Tasmania. If anyone's down there, happy to come and see her. But look, it's been a great experience. It's a family business. My wife works there. I've got staff that have been there for a long time.
And it specialises in one particular area of insurance?
Absolutely, yeah. Everyone always asks me this. There's over 1,600 lines in insurance in Australia, which is crazy. So general brokers, they'll do, basically all 1,600 lines. We do one. We only do trade credit insurance. We don't do anything else. We specialise in it. I guess that puts us in a position where we tend to deal with the really high risk policies that have, enormous touch points and needs and claims and losses and problems. That's where we fit in.
I'll swing to Luke and then we'll come back so we can get into the detail around these policies so the viewers can understand it. And Luke, you're Hilton Bradley Lawyers. You set that firm up a few years ago. Tell me a bit about your background.
Yeah, okay. So, started law in 1999. I remember emails coming in and everyone trying to figure out whether they're a good or bad thing. So a bit of a dinosaur. But, Hilton Bradley's been going for 5 years. We focus on insolvency, so we do a lot of work for liquidators, administrators, receivers. And we also have a practice that's integrated in that a winding up practice. So we'll wind up companies for clients that are owed money, but we'll get into that.
Yeah, and we will, because we want to understand how the winding up process works, what slows it down, what speeds it up. But back to you, Terry. So trade credit insurance, when does a client need it or a business need it?
Yeah, so probably like my smallest client is 2 million turnover. I think underneath 2 million turnover, it's probably not financially viable, but it certainly will help you grow fast. And so once you sort of hit 2 million turnover, it's the time when bigger exposures start to be a problem. But of course, what trade credit insurance is, it protects you from insolvency and not being paid. But it also, vets your clients to world's best practice, to the point where, a $1 billion worldwide insurer will assess the risk, which is something you can never possibly do at 2 million turnover. In fact, I've got clients that are, 600 million turnover that still can't believe the detail information that the insurers have. And that's the very starting point. We vet the client. We tell you whether or not it's going to be a good risk or not. And then we monitor that client to tell you that it's still a good risk while you're exposed. And obviously, at the back end, if that client starts to show problems, it may not even be problems to you yet, but it could be to the wider community of people that have trade credit, and their reporting starts to show that these people are suddenly not paying. They're suddenly going into payment plans or showing signs of stress.
Yeah. So I'm a client. So I come to you and essentially say, right, I'm a manufacturer of shoes or something. I've got 30 clients. I want to get some trade credit insurance. You'll look at those 30 customers of mine, not clients, let's call them customers because I'm the client. And you have all this data and information on those 30 customers. And let's assume that you approve us, we get the policy, and then where the real benefit for me then sounds like I'm getting constant information from you about those 30 customers. Yeah, and so you're getting things on Creditor Watch or the agencies or various businesses like that. Is that sort of how it works?
Yeah, definitely. There's really, really good mercantile agencies out there. For some of them are, better at some industries than others. Some people have the wrong, mercantile agency looking at information, and of course the insurers don't. They know where to be looking. But I specialise in the highest risk. So the highest risk is your building construction, your civil, the developers, builders, everything that you see around you are usually my clients. The plaster, the flooring, the painters, the scaffolders that put up the building, all the hire companies that go into doing the civil and everything else, the roofers. Those guys take on huge risks with builders that can go broke through.
Well, last 12 months is a good example. It's been a huge correction in that industry. So,
The data's unbelievable. This year, until the end of October, in my space, which, building construction, civil, and developers, 1,700 companies went broke in that 10 months. It's not even 12 months. And that is an absurd number. We've not seen anything near that for a very long time.
Yeah, I'm going to swing back later on that, where you think construction is, because, I've got a few views on that. But so let's talk about, coming back to my example, I've got 30 customers, and you start getting data and you say, right, okay, you've got 5 retailers out there that have come up on our watch.
Yeah.
What's the things that you're doing for your client to help them recover the debt? I mean, obviously you want to reduce your payout, right? So there's a motivation for you to do something there.
Yeah, so a policy has with it solutions, I guess, at the end of the day. So fundamentally, the only way you get a claim is if the company is in administration. Yeah. So what the insurers have done, and they've worked out that it's in fact a lot cheaper for them to provide free collections and free legal. So they pay for all of the
insurers.
Under the policy, they pay for that. So we partner with Hilton Bradley. That's one of our our major partners in terms of collections and legal.
Yeah.
And effectively, if we win, it's paid for by the insurers.
Yeah.
If we lose, the company goes into administration. Any form of administration is going to get you a claim. If it's a sole trader partnership, Hilton Bradley will bankrupt them, and therefore that will be how you get a claim paid. Claims are 90% of what's outstanding at the time of insolvency, and usually you're paid within 30 days, which protects your cash flow. Make sure you don't fall in a bigger and bigger hole.
I mean, I've talked many times, whether it's on this podcast, presentations, articles within our network, about the importance of working capital, so debtor, creditors and inventory. So I think that sits in the debtor space, where basically you're sort of giving them ideas on how to improve their collection techniques. I mean, because we sort of go off as restructuring practitioners and really want to educate not just our advisors but the client themselves on how to perfect their working capital. How do you get the best working capital in your business? Because if the best working capital creates the strongest cash flow, right? So So there sounds to me like there's an opportunity there for your clients to say, right, okay, Terry, what are some of the best practices that you see across your client base that we could adopt and stuff like that? Do we get into
absolutely.
that?
Yeah, DSO is what we call it in our industry.
Yeah.
I don't know if you guys call it DSO, Day Sales Outstanding.
Day sales outstanding, absolutely.
My biggest client when we first met them had a 69-day DSO and was doing 380 million. And from the very first day we met them, they had 8 people in accounts.
Yeah.
And that was a $380 million business, which I thought was probably, I've certainly seen businesses with more people than 8. But once I got to know them, they had very big exposures. So 8 people suddenly was probably too many. And we got the policy on, and the DSO was definitely a measurement from management from the very first time I met them, and they're north of 600 million now. So it's quite amazing. But they've only got 4 staff. We've definitely given them tools to be able to reduce their DSO. And a big part of that is talking to the client about the fact that they have trade credit insurance. And the whole, I guess, premise is, as a trade credit insurance policy, you're part of a community that must report anyone that's paying you late.
Yes.
And so we educate them and explain around, like, we've got to protect your client from the insurers stopping them from getting credit everywhere else and making that a nightmare for them. So what we need to do is we need to say, you need to pay us because otherwise we have to tell the insurer, and we don't want to do that.
Yeah, so there's a technique in the fact of having the policy is a collection technique.
Yeah, their DSO fell 15 days, I think, within 3 months.
With that style of approach.
Yeah, and it hasn't come back up in years, even in bad times. And they got rid of 4 staff because we took away, when they apply for limits, we approve them. And 9 times out of 10, it's approved in 15 minutes. So it's very quick. So you don't have to read reports. You don't have to take a guess, I guess, whether this client's going to be good. You just know the insurer is going to give you $100,000 or $500,000 or whatever it might be. So you're confident to trade with those. Even with new buyers, you're confident to step into large exposures.
It's almost like wielding the legal stick to reduce the legal need to necessity, which we're going to talk to Luke in a second about winding up. But
absolutely,
the sound like it's. I mean, there's been many situations where I've been in mediations and stuff, and a classic example is if you've got a litigation funder that funds you, and you can say, well, I'm funded, right? Now, if it's a big, strong balance sheet for a litigation funder, and the best one is FEG, right? It really helps with mediation because they know that we've got strong. So I suppose in some sense it's very similar because like your clients going off to their customers and saying, look, I've got this trade credit insurance. I'm comfortable because I'm covered, right?
Yeah, absolutely.
But there's processes that the trade credit insurance has to do, which is going to have detrimental impact to you. So,
absolutely. Yeah. The community factor, it's one of the only products in the world where it's quite funny when I see it because I've got multiple clients in the same space, but it is funny when you're reporting and you saying it's a bad risk is actually helping your same industry, your competitors, in the weirdest way.
Yeah.
It's helping them not step into that risk, and therefore it forces that client to keep trading with you and to solve the debt problem because they need supply. Yeah. So it stops them shopping the market because they can't pay people.
Yeah.
It's very strong like that.
Interesting. So we're going to swing to you, Luke. So we're specifically going to talk about winding up and the process, right? So you have clients like Terry.
Yep.
Just to start in that conversation, why don't we just run through the process of how does a client of yours take action to wind up a customer of theirs? Like, what's the process?
Well, it's kind of an interesting question commercially because different lawyers will approach it differently.
Yeah, okay.
So what many people might be familiar with is you go to your lawyer, you say, oh, this person owes me some money, and the lawyer says, oh, okay, well, I'll draft a letter of demand, and that very rarely gets paid.
Yeah.
And then you have a statement of claim,
Yep.
And so you'll pay your lawyer a filing fee, and you'll pay your lawyer a fee to do the statement of claim, and they'll file that, and let's assume that it's just a straightforward invoice. And after so many weeks of mucking around with the statement of claim, you'll serve the statement of claim, and then there'll be 28 days, and maybe there'll be some silly defence, and then you'll get judgment, and then you'll move on to enforcing that judgment.
Yeah.
Right. If you're talking about an undisputed debt, which 99% of people who have debts, they're undisputed.
Yeah.
There's just no need for any of that.
Yeah.
It's charity for a lawyer.
Yeah.
And it's horrible for your business because you're wasting time dealing with a lawyer.
Yeah.
And you're wasting fees you don't need.
Yeah.
Right? The beauty of the winding up process, and the major beauty, and there's several, is that you can go straight to enforcement.
Yep.
Right? What many lawyers will do is go through that letter of demand, statement of claim, and then they'll get judgment, and then they'll put it on the back of a statutory demand. Okay. So what I think people need to know is if you've got an invoice that's paid and it's not disputed, you can go straight to that statutory demand. So that's where, for us, the collection process begins.
Yeah.
Not 3 to 6 months before.
Yeah.
So what is that winding up process? Just giving that context. Okay, so society doesn't like insolvent companies because they go out and they cause a lot of damage. As they're struggling for oxygen, they'll go and find a new supplier, which what Terry was just pointing out, that the community can stop that with the trade credit insurance.
Yep.
And they'll go and get more goods and they won't pay for those, and gradually that sort of damage to commercial society cascades. So as a society, we don't want insolvent companies. We want them wound up, which is a term for getting them, having someone such as yourself bring in the assets and distribute those to creditors and take them out of circulation and make sure that creditors get as much as they can. Okay, so how do you do that? How do you prove that someone's insolvent? If you've got a bad debtor, you're not going to knock on their door and say, "Oh, can I have a look at your financials so I can prove that you're insolvent," and go and get an expert and all that. It's not going to happen. So what the courts do is they give you a shortcut, and that shortcut is the statutory demand. So you've delivered some tiles in the building industry to someone for $10,000 and they haven't paid. You put that invoice, to make it brief, you put it on the back of a document which is called a statutory demand, and you give it to the debtor. Now, they have 21 days to pay that. They can set it aside, but let's just, for argument's sake, saying there's no dispute with it. They've got 21 days to pay that statutory demand. At the end of that statutory demand, they are, and there has been no payment, they're presumed to be insolvent.
Yeah.
So there's your proof that the company's insolvent. You then go to the court and you say, Mr. Tiles didn't comply with the statutory demand as insolvent, so he's insolvent. Please wind up this company, right? And you'll apply, and about 4 weeks later, all things going to plan, that company will be wound up. And that company will cease to exist in its present commercial form. So, in a nutshell, winding up is a system by which we get rid of uncommercial companies, right? And you do that by demonstrating it can't pay an undisputed debt within 21 days.
Yeah. And I've always said that it levels the playing field because you've got, and you can see the impact of COVID where yours and our work dropped 70+% because those insolvent companies that need to be taken out of the economy didn't have to be taken, that weren't being taken out. And so and then of course we've had the correction or the catch up, not the correction, maybe the catch up since, right? But the damage that having insolvent companies in the market means that the strong players are being affected because the players that are not paying their tax, not paying their debts, going off to a different supplier, just being an all-round nuisance to the industry, are actually creating an industry that's not reflective of what the reality is. And look, maybe that's what we saw in construction. Like, I mean, okay, cost of goods, supply chains, shortage of people, all that. But then maybe it was also a combination of, some of these insolvent businesses not being dealt with in the normal course, which is something that Luke and his team does, for his business, right? So, it is interesting. Like, it's very interesting in the sense that the industries, the economy now, we've seen a pickup in the cycle of insolvency. I wanted to come back to you, Terry. Yeah. Recently, we saw the ATO start to register the delinquent taxpayers on Credit Watch. So tell me the impact that had on your business and your clients, because I suspect you probably had a number of these customers of your clients start to pop
it's interesting.
up.
I think it probably created a bit more fear than anything else, because I had clients that had limits with the insurers, and of course the insurers have gone and looked at their financials, looked at their audited fins, really assessed them, and had already ruled out the fact that they had tax debts because they'd already felt that the business was a good business. The ones that, I guess had big tax debts and suddenly the financials didn't make sense, the insurers would say, okay, we're winding back our cover on this buyer.
Yeah.
But our clients didn't have to worry, they didn't see the change really. It didn't really impact them as much as I thought it was going to. Couple of builders were told, sorry, you no longer have our support.
Yeah.
And they basically had 30 days to wind down the exposure to those buyers. Some of them have already gone.
Yeah.
Some of them have gone already. Some of them went within a week or so of that. So it's kind of, it could have strangled them. It could have, but they probably were gone anyway.
Yeah. Yeah. It's had I've had discussions with certain bankers where they've said that the credit recording of those tax debts has triggered a formal review within the bank around whether they are creditworthy and whether they need to refinance. They haven't taken a position, but it's certainly generated a lot of work in those credit teams within the banks around those notifications, because it's automatically they're signed up, probably just like you are, to the various agencies that can get the automatic notification on stuff that will help you and your clients. But
the insurers are the biggest spenders of mercantile agencies of anyone. They spend more money than anyone. Yeah. The insurance side of it actually helps pay for it too. When you pay for trade credit insurance, you do have to pay a fee every year for your reports.
Yeah.
And you could imagine, tens of thousands of policies around Australia all paying $1,000 or $2,000 every year to the insurers to help with that. It's a huge amount of money that's going into the reporting agencies.
So I want to come back to you, Luke, on the winding up. So that's a great explanation on how that process works. And for those watching, particularly people, and everyone pretty much is in a business, that ability to access that process and the importance to use the right legal advice around the process can result in sort of less costs and less time. So, I mean, you have the way you run things with your customers. Do you want to run through that a little bit and just tell us a bit about that?
Yeah. So, we realise that a lot of customers, they're not familiar with lawyers, and sometimes they're familiar with lawyers and it's been a bad experience.
Yeah.
It can often end in tears. Clients and their lawyers aren't always aligned, unfortunately. We want to be very aligned with our clients. So what we offer is it's a no-win, no-fee. And where that works is you've got a $20,000 debt. You're thinking, do I want to throw good money after bad? It's going to cost me $10,000, to go through the whole process.
Yeah.
And what we say is, look, we will do the work on a speculative basis. So this statutory demand, which we mentioned before, we'll issue it. you don't pay us a fee. We'll pay for the ASIC search and any service fees, minor disbursements, and we'll send out that statutory demand. If you get paid, we will take our fees, which is it's about $1,000, out of your recovery. So out of your $20,000. Now, hopefully, most people do, and they should have an indemnity in their terms of trade, which says if we incur any costs chasing you, you've got to pay it. So hopefully, we're sending out a statutory demand for $21,000. They pay within 21 days because, look, who wants to be wound up? Then great, we'll give you your $20,000 and we'll take the $1,000. So it costs you nothing. If you don't get a response from that statutory demand, we won't charge you. So it will again cost nothing. So there's no risk in you for attempting to recover that. So it's got a number of sort of benefits to that. First, you're not taking a risk with your finances. We're financing the recovery. The other thing is you've got lawyers who are aligned with your interest, right? We want a recovery.
Yeah.
Now, if they don't comply with the statutory demand, then, subject to your instructions, we'll move to winding them up. So we'll draft all of the necessary documents. We'll pay the filing fee for the court. All the collateral expenses, we'll pay that. And it's the same thing. We'll serve that on them. Now, if they can pay, they will, because they don't want to be wound up. Again, you'll get your $20,000. We'll get a cost order for about $8,000, and that will come out of the debtor.
Yeah.
It won't come out of your end of it.
Yeah.
Right? If they don't pay, company's wound up, you don't see a bill from us. Zero. So all you've done is send us a couple of invoices, you've signed a couple of basic affidavits, and that's your import, and you can rest. We've got clients, we ask how things are going, they say it's great. Once we know it's with Hilton Bradley, it's just going to be looked after, right? Because we've got far more invested in the legal process than the client. We don't have the investment in terms of the debt, but we've got the filing fees, we've got the time, and that's our business model.
Yeah, I can say something to it. I actually went out to a very large hire business this morning. We took them on as a client, I think, in February. So that means the insurance sort of kicks in from, when those debtors become a problem. And it was incredible sitting down with the director this morning, because he said to me the only outstanding legal matters we have with all the lawyers, then they had multiple before everything now goes through Hilton Bradley. The only thing outstanding is with the old lawyers.
The old lawyers, yeah.
But everything that's gone to Hilton Bradley's been paid.
Yeah. Well, I want to get onto that point. I mean, there's the final benefit, obviously, is that, of course, when it goes into liquidation, you get paid first, even before us as liquidators, and that's a very rare thing. Liquidators tend to get paid first. And so the petitioning creditors costs in a liquidation are paid first. They have ultimate priority. And so that whole process, if done correctly and efficiently, which you clearly do, is quite a good weapon for the customer. And like, you've got the proof there, Terry. But let's talk about success then. Okay, so I hear that and I sort of think, well, every corporate in Australia should come to Hilton Bradley and use you, and you'll answer, of course, right? But what is the success rate of the process? Like, are you getting 75, 80% of the what is it a high percentage that the actual customers that you're pursuing pay before it sort of gets to the winding up, to the liquidation, I should say, not the winding up?
Yeah, it varies obviously client to client, but it tends to be around that rate. And the reason is because there are several reasons. One is because we act quickly, you're not finding, because often, like if they owe you money, they owe other people money.
Yeah,
right?
That's right.
And it's the squeaky wheel that'll get the oil.
And you've probably got the data to tell them.
Yeah, definitely. Yeah.
So what we do is we make sure that it gets to the pointy end as quickly as possible, right? We don't give them time to manoeuvre and all that sort of stuff. The second thing is because our business model means that Hilton Bradley gets it in the neck if there's no collection. We demand that our clients have good debt collection practices.
Yeah.
Because if you're going to stuff around or you've got a weak link in your credit department that's stuffing around, we're going to say, I'm sorry, you can't use our product anymore.
Yeah.
Because
so you're giving them an added benefit. You're in there looking at their debt collection procedure, just almost like in a way like you, but differently, right? Mm-hmm. I noticed you mentioned terms of trade, right? I mean, you must look at their standard contract, their standard terms and conditions to see if they've got the proper clauses and improving that as well. That's probably another side benefit that comes from it.
Yeah, we do.
Interesting. So
I will say this: I know that trade credit insured clients are going to be the most motivated to get a result. Whether we start and get the collection paid, tick.
Yeah.
Whether we serve wind up and they pay, tick. If we knock them over quickly, tick, because I'm getting 90% back, and I know that within 30 days my client's got the cash flow back in the business. And so however it goes, it's fine. If you could imagine if you don't have trade credit insurance, it's starting to get a bit scary when wind-up begins. And if they offer a crappy payment plan, it could be quite appetizing to take the crappy payment plan over, the look of 100% loss on a debt if it goes to wind-up. So, I think we're definitely, the clients are a lot more committed because they don't care. It's gonna be money back in their business.
So is there any industries that you don't touch?
There definitely is. At the moment, solar is completely off limits. Yeah, solar companies in Australia, and you can just look at the numbers, go broke basically around when the warranty comes in. So as all of the houses get done, they rack up huge amounts of roofs. They have a warranty period that they have to have on those roofs. If it gets to 3 years and they're warranted for 5 or 7 and they start having huge claims, they just go broke. So then they exit out of all that risk.
But generally speaking,
it's not a good business to insure.
No, well, that's interesting. All about clean energy, isn't it?
It's uninsurable, unfortunately.
Yeah, okay. And but most other industries you'll cover, you'll look at, you'll consider, and then you'll look at the makeup of their customers and make a call from there whether they're insurable.
In the last couple of years, labour hire has been off limits. Because what companies that were showing distress were doing, they were losing whenever they had someone basically that would leave the business, they would get a labour hire company to fill the void, and they weren't employing new people. And so a lot of companies that were going broke were having huge labour hire debtors, and the insurers were just getting absolutely thumped. And so it became uninsurable because when claims are paying out hundreds of % higher than premiums that are coming in, the insurers look at it and go, well, do we really want to be in that space? And no, premium amount makes sense when maybe you haven't had a loss, but you don't know about 5 other people that are, in the same industry that have all been taken for 5 or 10x premiums, So it just sort of fades out in that space. It either becomes far too expensive or they just say no straight up.
Just change the policy.
Yeah. But almost everything else. I mean, in Australia, we're very blessed. We've got a couple of sectors where the government actually forces trade credit insurance to be in place. I won't say what sectors, but you could imagine there are sectors that have almost no risk. It's around licensing and things, and the insurer the government, almost has the insurer as a bit of leverage over those businesses. Those premiums are huge. And they almost pay for all of the building and construction losses that we see.
Oh, wow.
Building and construction, I don't think it doesn't make the insurers money. Yeah. They have to be in that space.
Yeah.
It's just such an important cog for the government. Realistically, only half of the insurers that are in Australia are actually willing to look at building construction. The other half are, we'll do it, but they're either stupidly overpriced or they don't provide the limits. They don't provide the cover.
Yeah.
Okay, so you've got a few insurers that are real, and you've got a couple of wannabes. And the wannabes I'm just talking about building and construction. I'm not talking about the safer spaces, but where I play, the highest risk, and where clients need me because they're going to have claims, right? And they're going to have problems with collections and legal. That's where I play, and having those other insurers in the market can be, a little bit, a bit disappointing because they're billion-dollar worldwide insurers. And I get clients that are from those countries sometimes, and they're like, they're the best, but they probably are in their country. And some of them are the biggest in Europe or the biggest in America. And like the biggest in Australia is QBE. Yeah. They're probably the best in terms of risk appetite, taking on risk that, which is what you want.
Yeah.
You have a policy, you want them to take on all those risks so you can grow into those risks. But QBE, I imagine, in America and Europe would be so small, and probably it'd be the same conversation I have with a client in Europe or in America, where they'd say, "Oh, QBE, don't know who they are, and they're probably not very good." Whereas in Australia, they're the leaders, and they're so far in front, particularly in construction and the higher risk policies. They leave the others for dead.
Well, final thing to cover off on is where we think the market's going to go in 2024. So, Luke, what's your thoughts there? I mean, putting it into your lens of the work you do, I mean, you obviously, we haven't talked on the broader insolvency work you do, but obviously you do work for people like myself, and you've done a couple of matters for me. What do you think the winding up market's going to look like next year?
That's a very good question.
You're allowed to be wrong. So
okay.
You gotta have a.
Well, I just look rightly or wrongly, right? And I'll be interested to this period to give me some education, right? But I look at the ATO.
Yeah.
Okay.
Yeah.
I think it's rocket science. I think I don't know, like between the bushfires and when COVID sort of settled down, maybe 12 months ago. They wound up how many companies? Maybe
10.
10. Like I feel silly saying 10, but I think it was 10.
It was some silly number. Yeah,
I think we wound up like multiples more than the ATO did, right? But I look at Friday's list, and there's 15 in one day.
Yeah.
And what I always tell, I mean, maybe your listeners, it's probably telling them how to suck eggs, but if I'm having a beer with someone and they ask me that question and they're in a different industry, I say, well, look, the person that owns this pub, if they're insolvent, they're going to pay their staff, they're going to pay their supplier, they're going to pay their landlord, and then the ATO is going to be paid later. And I call it the Great Australian Overdraft.
Yeah,
right?
It's the biggest.
And so all of that debt has backed up into the ATO.
Yep.
And for me, they're the sleeping giant. I mean, I said, as soon as Albo got in, they'd get stuck into it so they didn't have to deal with the pain closer to an election. Shows you what I know. But yeah, if anything does deteriorate, I think it'll be that's going to be the first domino that will fall over.
Yeah. And I think in that sense, for people that have got a debtor book, and that's most businesses, it's very important to take a closer look at the moment. And it's all about good working capital management. And one of the working capital management is making sure, the one that you did for me, that accounting firm, and it was 2 years old, the debt, and they couldn't bring themselves to spend the legal fees to wind it up. And then, of course, I put them in touch with Hilton Bradley. They got paid. And it was like...
It happens a lot.
They think I'm like godlike now, but like it's
you get that too, okay.
But like, I didn't do anything spectacular. But the point being is that there are, it's very important to have strong working capital practices, and the legal avenues that you provide, Luke, and is part of strong working capital and trade credit insurance, Terry.
Yeah, definitely. Yeah.
And what about you for 2024?
Yeah, look, I think it's I go out and see a lot of clients, and I go around the whole country, right? So, in the last few months, I've been to Perth, I've been to Darwin, I've been to Adelaide, here in Sydney today, and I don't live in Sydney, I live in the Gold Coast. So, that's a lot of miles. every single state is different. It is absolutely crazy how different it is. Darwin's been in a perpetual low it's been in a low since the gas, setup stopped. Yeah. I mean, you talk to them and they're like, they're feeling better because it's just been so horrible, and I don't think it's that better. I mean, they had a bit of inflation, so it looks like they're making more money now, but realistically, what's that money worth? I don't think they've really made a lot more money. I think they're making the same money, but the inflation's masking the fact that that's gone up, but what's that buying you now, right? It's not buying you a lot. Adelaide's doing okay. I think it's doing better than most states. Perth is doing well, but we just had a big insolvency there not long ago, and so I've got a few clients feeling a bit sick about that insolvency. But that insolvency actually started in Victoria and Sydney. The Victoria and Sydney business fell over, and it dragged a business that was doing well in Perth into it, which is sad, but that's unfortunately you guys helped us with that one. But it's sad, but you know what? I think if that business was only in Perth, it probably would have made it. It got dragged in. Victoria is a sad state. It is. Everyone I talk to there is in misery, and they're not making money. And I'm not hearing, I'm going to go buy this company in Victoria. There's everyone you go and speak to is pretty negative. It's not. I hate going there actually at the moment.
But the insolvencies are much lower than New South Wales, right? And so I feel like
crazy.
Victoria next year is going to be the active state when it comes to insolvency. But you're right. It's not positive.
Yeah, it's not positive. I think New South Wales. I mean, I've been out to Penrith this morning. I've been to Silverwater to see a client, and I walk in and they're positive, and they're talking about acquisitions they might make. You're not having any of those conversations with people in Victoria at all. Nothing. Yeah. It is, how can we hang on?
Queensland. Tell me about Queensland.
Queensland's absolutely booming.
Yeah. The Olympics, I suppose.
It is booming. You have got up there. Don't tell too many people, but like you've got up there quite a spectacular thing where you've got, like where I live, the Gold Coast has actually sort of crossed a certain amount of people where we're not going to have that boom and bust cycle that we've had for the last couple of decades. You've got real industries up there. You've finally got companies that are moving up there from Victoria. Yeah.
I can name 5 people that have moved up there in the last 6 months.
Exactly. I mean, it's still amazing. I live on acreage. It's still amazing. I bought my acreage 6 years ago when I moved up there, and it's a sickly $720,000 for 8 acres. And I look back now and I think, thank God, thank God I bought it. At the time, it was probably about $150,000 more than a house. And it was unbelievable. But that, when I'm looking across the valley every morning at a house that just sold for $3 million. That sort of shows you the prices and how they've gone up, but they're still nowhere near Sydney. The equivalent in Sydney would be 10 or 15 million.
And that's look, for me, I mean, my final note for the year in our thought leadership article is that I think we'll see hospitality and retail impacted, discretionary spending. I still believe there's 2 more interest rate rises.
Wow.
I'm quite happy to be wrong. I think most insolvency practitioners have been wrong for the last 5 years in terms of predicting what was going to happen, right? So, but I still think there's a couple more to play out. I think the construction's through the worst of it. I think they have really worn it. I think they will potentially struggle is the lack of potential funding and just some risk-averse behaviour which is already showing signs of a good slowdown in construction builds and stuff. But that's where I think I do think the insolvency market will be active next year. And I'm quite happy to eat my words in 12 months' time. But it just you think about the ATO behaviour that you said, Luke, and that's really ramping up. And that's still a lot to play out there. And even in the ATO space, you're starting to see lockdown director penalty notices being issued 2 years after the company was deregistered to the actual directors. They're going back and they're looking at the lodgement behaviour, because of course once you lodge your BASs outside the 3-month late notice, I think it's 3 months, but a certain period, you are then subject to what's called a lockdown director penalty notice, which liquidation doesn't protect you. It makes you automatically personally liable for it. Well, thanks, Luke and Terry. That was a great chat about trade credit insurance and legal advice around the enforcement and collection of debtors. I think for the viewers watching today, it's important to think about working capital and the working capital for your client's business. It's important to consider whether the trade credit insurance is something that works for your clients and for your own business. People like Terry, you can see through what he said today, was talking about how they help their clients improve their collection procedures. And Luke touched on about those clients of his that have good collection procedures. They have a much greater success around recovery rather than taking their time, the 6 months. And Luke talked about the processes of enforcement. So again, from a legal perspective, it's important to use the right lawyers for the right process. And certainly Luke's team has that, especially when it comes to that enforcement. But for our viewers, have a great break. Have a good Christmas. We'll see you back in 2024, and thank you very much for this the 2023 season.
Thanks for tuning in to Cathro & Partners The Cut. We hope you've enjoyed today's episode. For more insights, please visit our website, cathropartners.com.au, or find us on LinkedIn.